Intersection. All right. District. Like, I thought I was like, oh, they're trying to like, I thought they're trying to like, come up and you know, take the I said, go over and tell you.
Hey, how's everybody doing? Okay, okay. I don't know if you guys saw I posted the first research case. It's on Canvas for you now. It's due in a month, I think first week in November, so there's plenty of time. We can look at it really quickly right now. So you have 4 documents there. This is the case. You do an account receivable. Start by reading through this. This is a PDF copy of the case. Then you've got a spreadsheet. This is what you're going to fill out. Your work papers. Okay, so here's tick mark legend. These are all the different tick marks you use. Copy of the balance sheet, the income statement. Trial balance, aging of accounts receivable. And there's a bunch of different tabs here. So first you read through the PDF copy, then what you'll want to do is here, these case instructions. Okay, this walks you through. All you need to do is follow this. This tells you in detail what you need to do. Okay, this walks you through every step. Like, let's see here. Step 1A. This requires you to test the mathematical accuracy of AR aging. Begin this by first selecting the assertion being tested. You recalculate all equations, footing and cross-fitting in AR aging 1. So here you are. Here's AR aging 1. So what are you doing? You're adding up all these numbers. If you already know, it's called footing. That's the first step. For a simple thing, but that's how you get started. Okay, and then you just continue to follow these directions in the Word document. They walk you through every little thing. Okay, so there's nothing really hard about this. You just got to be careful, do the work. It'll take you several hours, so I don't recommend you wait till the last minute. There's also, that's 3 documents. There's a 4th document. Your case exhibits. This gives you some material. So one thing I can recommend, read everything that's in there, okay? The PDF copy of the case, those case instructions, the exhibits, there are little things in there that you're going to need as you're going through. The end result, what I'm mostly going to grade you on is SAD is where you make the adjusting journal entries. Okay, that's mostly what I'm going to be grading. So they gave you an example here already. So here, this adjustment represents a significant repair on a truck that was improperly capitalized. So there was some expenditure on an asset, in this case a truck, and they capitalized it. They debited the truck, but they shouldn't have capitalized it. They should have expensed it. So instead, to correct it, they debit the expense and credit the truck. Okay, so that was one error they found, and this is their suggested journal entry to correct it, the adjusting journal entry to correct it. The rest of these tabs here are the other mistakes you're going to find, and you're going to suggest the journal entry. You don't necessarily have to fill out every one of these, but most of them. There are a few really important ones, big mistakes that you need to find. If you're missing those, I'll take off a significant number of points. There are a couple of smaller errors. I would just take off 2 or 3 points if you missed one of those, but try to get all of those if you can. Okay? No, no. Um, Okay, so like I said, there's nothing incredibly difficult about it. Just take your time. Those are detailed instructions. They're designed for students, your first try at doing actual work papers. So it walks you through everything. Just do exactly what they tell you, and it all can be done. Okay, and don't wait till the last minute. I also I don't like to answer a lot of questions on this assignment. I want you to do it like you're really on the job, having to do this on your own. So please don't come to me with a lot of detailed questions about it. I'd like you to try and do this on your own. Yeah. I some feedback. I can tell you if it's a disaster. I will not. I can't tell you these are all the right answers, and you could just tell the rest of the class I got all the right answers. So, yeah. Yeah. No, I would suggest you not formally submit it. Maybe send me an email. I'm done. How does this look? And I can say, this is a disaster. You need to start over at the beginning. Or I can say, you're on the right track here, something like that. Okay. Any other questions about this? All right. So, like I said, don't wait too long. At least start looking at these things, reading through the case. It's not due for a month, so there's no big rush on this. Okay. I think we finished chapter 6, right? And the articles, we just didn't do a problem out of chapter 6. Is that right? So I've got one problem out of chapter 6, and then we'll go on to chapter 7. Oh, is there any administrative issues or anything anybody needs to talk about? All right. Okay, so let's do this problem, chapter 6. Here, 6.48 on page 253. 6.48, page 253. No. Okay, so here you've got the client's bank rec. Okay, so you remember we talked about this a few chapters ago. The client does the bank rec and they give it to you. Okay, and it becomes part of your work papers and you're going to go over it and audit it. So you're going to write at the top. Do you guys remember? What do you write on stuff that the client gave to you that they did? PBC, prepared by client. You're going to write that on the top of this work paper. And then you're going to go about auditing the bank reconciliation. Right. So let's go through here. This is for September 30th. The first line says balance per bank. So as an auditor, what are we going to do? It says balance per bank. What are we going to do with that? The first line, like any bank rec, it says balance per bank and they give you a number. What are we going to do with that? Check the bank statement. We get a bank statement directly from the bank. They mail it directly to us. We look at the bank statement. We look at this balance per bank and make sure that is the balance in the bank statement as of September 30th. Then we put a little tick mark that we checked it against the bank statement. Right. First thing we do. Next is deposits in transit. A little review. What's a deposit in transit? Right. You dropped it off in the ATM slot the night of September 30th. So when they send out the bank statement the morning of October 1st, they haven't recorded it yet. So it's on your books as a debit to cash. It's not on the bank statement yet. So you have to reconcile them. Okay, so there are two of them here, September 29th and September 30th, you recorded that haven't ended up on the bank statement. You as an auditor, what are you going to do with these deposits in transit? Right. A deposit slip, when they deposited with the ATM, they should have gotten a little receipt. You can check those. What else can you check? That's right. There might be a subsequent bank statement you could look at. Yeah. Right. Journal entries. What would you expect the journal entries are? Right. Debit cash and credit to account receivable, probably, right? Most likely these are customer payments. So you would have seen a debit to cash, credit to account receivable for those accounts. And you can look on September 29th, here are all the checks. September 30th, here are all the checks. And what else should you see? Yeah, the check number, that's good. I'm sorry, I'm not asking it right. Um, they did the journal entry on September 29th. What should you see? They deposited it on September 29th, right? We talked about that same day. You deposit cash and check. So if they received it on September 29th, you should be able to match that up. It was deposited the night of September 29th. Same day it should be deposited, and the same with the September 30th deposit. Okay, everybody following us? All right. Then there's outstanding checks. What are outstanding checks? Right. We wrote a check like to pay off an account payable. It hasn't gotten through all the way to our bank yet. So we've recorded it as a credit to cash. The bank doesn't have it on the bank statement yet. Okay, so what are we going to do with those? Auditing them. Right. Like a subsequent statement would work. Yeah. Mm-hmm. And check the journal entries that it was a debit to accounts payable, credit to cash. Okay. One. Yeah. Yeah.
Last how old it is.
That's right. That's right. That's right here in this problem. This is the September 30th bank statement, and there's an outstanding check from August 31st for $2,200. So $2,200 has been sitting around for a month. Somebody didn't cash it. That's a red flag. Probably okay, but you definitely want to follow up. Why has this check not been cashed yet? Okay, now this problem here, the textbook, they threw in something interesting here. So if you've got the problem in front of you, they have all these outstanding checks. There are five of them, and then they added them up to a subtotal. What are you going to do with that? They five checks added up, and they got a subtotal. What can you do? Right. And what do we call that? Adding up a bunch of numbers. Footing. We're going to foot these numbers, and if you do that, they've written that it totals to 11,450. If you add them up, they do not total to 11,450. That's very suspicious, right? This bank rec only reconciles because they put down 11,450. So it kind of looks like somebody's manipulating this bank rec. So this is a definite red flag. You need to follow up what happened here exactly. And again, you found that potential fraud by doing something as simple as footing a subtotal. Okay, then customer note collected by the bank. All right, you guys have heard of these, a note receivable, where you have some special arrangement with a customer, they'll pay you later and pay you interest. You have the bank collect that directly. So they've got one of those. What would you do with that as an auditor? It should be on the bank statement, right? That the bank collected it. You can check that. You can check the underlying agreement, this note receivable with interest payment terms and all this kind of thing. You can look at that, make sure everything checks out. Okay, here's an interesting one. Error. Check number 1282, written on September 26th for $270, was erroneously charged by the bank as $720. Okay, so you wrote a check for $270. The bank recorded it as $720. Okay, first off, how often does that happen? A bank misrecords a deposit. I have never had that happen to me in my life. I'm sure anything's possible, but let's call that very rare. So I'm a little suspicious of this one. You definitely want to look that up. They're claiming it was the bank's mistake. And then finally, balance per books. And they have a number. What are we going to do with that? Balance per books. Check the books, the trial balance, the general ledger, and make sure that is the amount in the cash account. Okay, everybody feel good about that? All right. So we can go on to chapter 7. Okay, so I think I mentioned last time, these next four chapters, chapters 7 through 10, are the account cycles. Okay? We had talked about walkthroughs where you follow a transaction through the accounting process. Those are called account cycles, how a transaction moves through the business. Like here, we're doing the revenue and collection cycle. So this company, this your client here, how they make a sale, they get the order all the way to collecting the account receivable. That's called an account cycle. Okay, and these next four chapters are the major account cycles. Okay, so this is getting down to the nitty gritty of actually testing, looking at documents, and auditing. Oh, right. And one thing I want to remind you when we're doing these, we're taking now in these four chapters all the principles and basics that we learned in the first few chapters and applying them to specific accounts. So vouching and tracing, existence and completeness, segregation of duties, all that stuff we learned, we're just applying them to the revenue and collection cycle. How exactly we're going to test those things with those big picture ideas in mind. So when you're getting confused with this, try to think about that. We're just going back to all the basics that we already learned and applying them to specific accounts. You attendance sheet, anybody? You need to. All right, so let's get to work on this revenue and collection cycle. Okay, so one way you can organize it when you're doing an account cycle, think about what is it you're doing. So what are the PCAOB assertions that we're going to be testing when we're doing the revenue and collection cycle? Existence. We're going to be confirming accounts receivable, confirming the existence of accounts receivable. You guys may have heard of this. This is a standard audit technique you'll do pretty much all the time. You're going to actually write letters to the client's outstanding accounts receivable customers and say, is it correct that you owe the client $2,000 in accounts receivable? And they're supposed to write back to you, yes, that's correct. Okay, that's called confirming the existence of accounts receivable. You make sure that there is an actual customer out there who is really planning to pay. You're confirming existence of accounts receivable. One of the major tests you'll do. Okay. And inspecting shipping documents. What's that testing? What are you doing when you inspect shipping documents as part of the revenue cycle? Existence of what? Yeah. The sale, right? Or particularly the occurrence of the sale. They wrote on the income statement all these sales occurred. That's just a line on the income statement. Did that really happen or not? You can look at shipping documents. If they actually have a receipt from FedEx that they shipped out a real product to a customer, that's evidence that that sale really took place. So you're testing the existence or specifically the occurrence of the sale. Okay. Completeness, sales cutoff. We've talked about that. Sales cutoff testing is around the end of the accounting period, making sure everything was done in the correct period. So you're checking the completeness of the sales account. Okay. Factoring and pledging of accounts receivable. You guys remember this from 351? Yeah. Can you tell what is factoring accounts receivable? That's pledging, but very close. Thank you. Yes. Factoring is when you sell the account receivable, right? You sell it to a factor. They will pay you like 95% of the cash, and then they will collect the receivable. It belongs to them. Does that sound familiar from 351? Okay, good. Now, for an auditor, why is that important? From the auditor's perspective, why is it important that you check factoring of accounts receivable? Yeah.
You want to make sure that there's not saying that people owe them money when they actually like sold those accounts.
That's right. Accounts receivable listed on the balance sheet means you have the right to collect those receivables. If you sold those receivables, factored those receivables, you don't have the right to collect them anymore. They don't belong on your balance sheet anymore. So one of the things you need to ask, these accounts receivable, any factored accounts receivable here? If there are, you need to take those off. Okay, and then pledging, like you said, when you use accounts receivable as collateral for a loan. So that's relevant to the auditor. If these accounts receivable have been pledged as collateral for a loan, maybe they can't be used to pay any other debts. They're strictly to pay back this loan. So, um, right. When you're doing like when someone is analyzing the company and doing like current ratio, when they do current assets, they should not be including those pledged account receivable as current assets because those assets are not available to just pay off loans generally, current liabilities. They are specifically to pay off something else. So there should be maybe in the footnotes or something details saying $10,000 would be the account receivable or pledged as collateral for this specific loan, not available to pay off any other debts. Okay, so again, checking the right. Do you have the right to these accounts receivable or the right to use these accounts receivable to pay off other debt? Okay. Valuation, we know all about that. Bad debt expense and allowance for doubtful accounts is properly valuing the accounts receivable. Sales returns and allowances and sales discounts are properly valuing the sales account. You have gross sales, less sales returns, less sales discounts equals net sales. Okay. And presentation and disclosure, well, we just talked about that. A pledged account receivable should be in a special account called assigned account receivable, segregated from the rest of the accounts receivable. And of course, you need to disclose your revenue recognition policy. Okay, you want to think about what accounts am I going to be looking at when I'm doing the revenue and collection cycle. Cash I'm going to be looking at, accounts receivable, the related accounts to accounts receivable, ADA and bad debts, sales, and the related accounts to sales, sales returns and allowances, and sales discounts. And so when you're planning out what accounts am I going to be looking at, you can make up a list. These are all the accounts I'm going to have to be looking at for this. Okay, now here, I don't need you to know this part. These are from my old 351 slides. I'm just wanting to remind you guys. The only way that you can audit somebody else's financial statements is if you know US GAAP. So if you're going to be auditing their revenue, you need to know how revenue is recognized under US GAAP. So how is revenue recognized? Revenue should be recognized when promised goods or services have been transferred to customers in return for an amount that is expected to be received for goods or services. If you don't know that, you can't do an audit of another company's revenue. Okay. Another example of things you need to know the US GAAP for sales returns in order to check whether your client has done sales returns properly. So, how do you do sales returns? Sales returns are recorded when the item is returned. When books are closed, an adjusting entry is made to record any expected future returns associated with the current year's sales. For example, merchandise costing $150,000 is sold for $200,000 on October 10th. Historically, 1% of sales are returned. That would be $2,000 in sales returns. On November 14th, merchandise sold for $800 is returned. Okay. So first you record the sale, 200,000, and the cost of goods sold and inventory was 150,000. You record a sales return and take that off, and you record that it's back in inventory for the actual good that was returned. And then you have to make an adjusting entry for the sales returns that haven't happened yet, as of the end of the year, an adjusting entry. So you record sales returns and allowance for sales returns for 1,200. And you put it back into estimated inventory because you don't actually have it yet. And then when the returns are actually made, take it out of allowance for sales returns and out of accounts receivable. And now you can put it back into regular inventory, take it out of the estimated returns. Again, I'm not going to ask you this on an exam. I just want to remind you guys, you need to know these things so that you can audit their sales returns account. Everybody with us right now? Okay. Okay, so we had talked about one thing. We're coming back to all the principles that we learned with each account cycle. So one thing we have to do is document our understanding of internal controls. There are three basic ways to document your understanding of internal controls. What are they? A questionnaire, a narrative, and a flowchart. Okay, so here's an example of a simplified flow chart I put together for the revenue and collection cycle. So how does your client go about making a sale? Okay, step one, they receive a customer order. Okay, and there's a piece of paper, purchase order, customer order. Second, they have to approve selling to them on credit. So maybe that's a separate document, or maybe it's just a signature on the purchase order, but that's the second step in order to sell. Now they're ready to ship the goods to the customer. There should be a copy of the shipping document from FedEx or whatever. Then they're ready to bill the customer, send an invoice out. And now once they've shipped it, or once it's been delivered, whenever the revenue has been earned, you can go ahead and record an account receivable and sale, do the journal entry at this point. And then finally, hopefully the last step, you'll collect the cash of the account receivable from the customer. Okay. And all of these documents along the way could be stapled together and made into a, what do we call that? A voucher package, which also serves as the audit trail that we, the auditors, are going to look at to make sure that this was done properly. Okay, again, coming back to our principles, we're back to vouching and tracing. So here you've got the sales journal where you recorded all the sales transactions, and here you've got shipping documents. So we're going from not the financial statements in this case, but the sales journal to the original document. Okay, somebody explain, what are we looking at here? When it says sales journal and an arrow to shipping document, what does that mean? What would we be doing? No, that would be vouching, right? Because we're testing existence. It says here we've got a journal entry that we made a sale. Did we really make a sale? We want to make sure that sale occurred. What? I'm sorry? No, this here, the sales journal is just the journal entries, right? We made a sale today, we made a sale tomorrow, something like that. We want to check that this sale really occurred. What's one of the basic ways we said we check whether a sale occurred? We look at the shipping document. Okay. So you test the existence or occurrence of the sale by going from the journal entry and vouching to the shipping document. And then what's the other way around? What would you be doing? Tracing, and we call that is testing. Tracing is testing completeness. What exactly are you doing? Right. Make sure that every one of these shipping documents was recorded as a sale. It's complete. All of the shipping documents, every actual sale of a product you made, got recorded in the journal as a sale. Okay. And since this is the revenue account, which one of these procedures is more important? Vouching, right. Why? But you're worried that they will overstate revenues and assets. So you want to make sure that they exist. So that's how you do, that's vouching, is testing the existence, because you're worried they'll overstate revenues and assets, make up sales that didn't really happen. The It's less important to test completeness. You're not really concerned that they would understate their sales. The company has no obvious motive to do that. It's possible you still want to do some testing of completeness, but it's not as important. As far as prioritizing risk-based auditing, the most important thing with the sales account is to test existence or occurrence of sales by doing vouching. Okay, everybody following that? Any questions about that? All right. Okay. Improper revenue. Oh, yeah. So we're talking about the big risks as always. Risk-based auditing. What are the big risks when you're doing the revenue cycle? You're worried about improper revenue recognition. They would recognize sales that didn't really happen, or they would recognize them early or something like that. That's one of the big risks that you want to focus on. So you're worried about fraudulent sales. Okay. Here they have some basic techniques for improper revenue recognition. Cutoff, which you guys know means recognizing the sale early in an accounting period before it happened. And then here are three common fraud techniques that we're going to talk about right now: bill and hold, channel stuffing, and lapping. Okay, let's talk about those. Okay. Hocus pocus accounting. Okay, so first, let's read this little thing where he talks about it in general. Deals called sham transactions refer specifically to sales schemes that appear genuine, but actually are rigged for the purpose of letting the seller recognize revenue. Other indicators that fraudulent financial reporting might exist include bogus shipping dates, revenue figures that always meet analysts' expectations, and transactions with unusual payment terms. Auditors with a good understanding of the client, the business, and its products are well prepared to see the warning signs of revenue recognition fraud. Okay, so we've talked about that before. You need to know your client and how they go about doing business. They should have a standard way of doing things like recognizing revenue. And then you can identify if they're doing anything out of the ordinary, you'll notice it. You'll only notice it if you know how they usually do things by understanding your client. And then he goes into the specific thing here. One of the most common schemes is the bill and hold sales transaction. While it's not necessarily a gap violation, it's often associated with financial frauds. Yeah, have you guys heard of that bill and hold? No? Okay, that's fine. So what'll happen, let's say Target, they want to have a bunch of Christmas toys for the Christmas season, but they don't want them on the shelves all year. They want to put them on the shelves in November or whatever. Right? But they're not going to wait till the last minute. They will buy them from the toy manufacturer months before and then just take delivery of them for the holiday season. Okay. So they will have an arrangement. They'll go to the toy manufacturer and they'll draw up a contract, a sale. We're buying these toys from you in June or July or something. But we don't want to take delivery because we don't want them on our shelves until November. So that's perfectly okay. It's called a bill and hold. What the toy manufacturer will do, they take that inventory the Target just bought and put it in a corner of their warehouse with a big sign on it, not for sale, already purchased by customer. Okay. So a bill and hold transaction is a legitimate sale if there's a firm contract, not just a handshake, a contract that Target bought these things, and the inventory is segregated. Segregated. That's put in a separate part of the warehouse with a big sign, not for sale, already purchased by customer. Okay, so a bill and hold can be a legitimate sales transaction in situations like this with things like holiday shopping and stuff, as long as you have a firm contract and inventory is segregated. Yeah. Oh, you mean checking up on whether it was fraudulent or not? Yeah, yeah. So first, yeah, let's talk about how could that then be a fraud? The toy manufacturer, if they need some more sales, they could just say, well, Target always buys from us. We'll just go ahead and record it as a sale now. I'm sure they'll get in touch with us and we'll sell to them like they always do, even though they're not delivering it yet. Okay, that would be another way to commit fraud. So bill and hold can also be a common fraud technique, even though it can be a perfectly legitimate transaction. So again, yeah, what you could do, the toy manufacturer, you'd want to look at it. They're claiming they have all these bill and holds. Let's actually look at it. Do you have a contract that this was an actual sale, not just you're hoping it's a sale? And have you segregated the inventory? If you did that, then the toy manufacturer can legitimately recognize revenue to bill and hold. Okay. And then he gives an example as well. Although bill and hold method is not in itself a gap violation, it's difficult to audit and has long been associated with incidents of financial fraud. Bill and hold fits the fraud risk factor description in SAS 82, consideration of fraud in a financial statement audit. You remember we read that one, consideration of fraud. I just think the number's different now. Unusual and highly complex transactions that pose difficult substance over form questions. In a bill and hold deal, the customer agrees to purchase goods, but the seller retains possession until the customer requests shipment. An example, a municipality building a sanitation plant buys equipment for the facility and delays delivery until it's completed. Okay, so a city is constructing a new building. They order the air conditioning system months in advance, but they don't want it delivered until the rest of the building is there so that they can install the air conditioning. So that could be a bill and hold. The seller may be able to book revenue even though nothing has been exchanged physically. This is a legitimate business purpose for a bill and hold arrangement because two conditions are met. The revenue is realized or realizable and it is earned. Okay, now they're talking about how could this be fraud? GAAP requires that revenue recognition be based on whether the revenue is realized or realizable and earned. Revenues are commonly recognized at the time of sale, meaning delivery. So, like we just talked about, the revenue recognition rules say you recognize revenue when control of the product is transferred to the customer. In this case, that's not happening. You're recognizing the revenue even though you haven't delivered it yet. That's what makes these complicated and open to fraud. And so because revenue recognition on bill and hold transactions departs from this general practice of recognizing when delivered, the auditor must know how and why a company maintains that using this method is justified. Okay, so you as the auditor would ask the toy manufacturer, why do you have all these bill and hold transactions? And they would explain, we have a lot of retailers who only want the Christmas stuff at Christmas season, but they want to make sure they're going to have it, so they buy it months in advance, and we hold on to it for them. Okay, that's one fraud technique, bill and hold. Another one, you guys might have heard of this example. This was a real life case with Krispy Kreme. This is called channel stuffing. Franchisees alleged channel stuffing, claiming that some stores were getting twice their regular shipments in the final weeks of a quarter so that headquarters could make its numbers. Okay, so what Krispy Kreme would do at the end of the quarter, if they were a little short of their sales numbers, they would go ahead and ship out a bunch of extra donuts to all the grocery stores and franchises that bought their stuff. The franchises would receive this stuff, say, we can't use all this, and ship it back. But those sales returns would be recorded a few days later in the next quarter. For this quarter, they got to recognize those extra sales and make their numbers. Okay, that's called channel stuffing. Yeah, that's fraud. That's fraud. You know you're not going to make a sale. You're trying to make it look like you made a sale. You know perfectly well that they're going to send it back to you and you didn't make a real sale. Obviously, it's always difficult to prove fraud. You would have to look into it, but that is what was going on at Krispy Kreme. They said, we're short of our sales numbers. We need some more sales. What are we going to do? Let's just ship out this many extra donuts and go ahead and recognize it as a sale. And in the next quarter, we'll recognize the sale return when they ship it back. They knew that's what they were doing. For an auditor and the SEC, if it goes that far, to prove it.
Like the franchiser like request certain amount of product? Like is that documented? Like
Yeah, it probably would be. Yeah, we request this many boxes, and then they send them more.
like 100 and 200?
Yeah, that would be good evidence. Yeah. Okay, so why did Krispy Kreme do this? Once Krispy Kreme went public, once they became a publicly traded company, there was enormous pressure, as there is for all companies, to grow very quickly and sustain growth quarter after quarter after quarter. Okay, here's another interesting case. This is back to factoring receivables again. Historically, Happiness Express had factored most of its accounts receivable. A finance company typically approved or authorized Happiness Express's credit sales before shipments were made to given customers, and then provided cash advances for the resulting receivables. This practice significantly reduced the credit risk that Happiness Express faced on its outstanding receivables. At the end of fiscal 1994, approximately 88% of Happiness Express's receivables were factored. Okay, so these guys, this business, Happiness Express, that would be a standard part of their business. They would factor their receivables to get the cash faster. Okay, 88% of their receivables they typically would factor. Nothing wrong with that. That's the way they wanted to do business. Here, now what happened here though, because of the bogus sales entered in the company's accounting records near the end of fiscal 1995, only 19% of its receivables were factored at the end of that year. How is that an indication of fraud? They usually have 88% of their receivables factored. This year was only 19%. Okay. I'm sorry. Yeah, it is significant, but what was actually going on this year? These guys had a bunch of fraudulent sales. The factor isn't going to take fraudulent sales that don't exist. So only 19% of their sales were actually real this year. Okay, Coopers and Lybrand auditors. I don't know if you guys know this. There used to be actually, there was the big eight up until like the 1980s, the big eight accounting firms. Then there was the big six, and now there's the big four. But when it was the big six, Coopers and Lybrand was one of the big six accounting firms. Then they became Price Waterhouse Coopers, part of the big four. But what they're talking about here was Coopers and Lybrand used to be one of the big six accounting firms. So the Coopers and Lybrand auditors apparently never learned of this change in the nature of Happiness Express's account receivable and consequently failed to make the appropriate modifications in their planned audit procedures for that important financial statement line item. The allegation here is that Coopers was reckless when it relied on a previous year's information without bothering to independently assess the current year's data, which was vastly different. Okay? So we already learned about this. This is doing analytical procedures. You look at trends. Typically, every year they had around 88% of their receivables factored. Then, like you were saying, all of a sudden this year, it went all the way down to 19%. You don't know what's going on, but you would notice there's a huge inconsistency. That's a red flag. I need to follow up on this. And then you would have found the fraud. But Coopers didn't do that, didn't do the analytical procedure on this, and so they didn't find the fraud. Okay, here's another one. This is a little more complicated. Another fraud technique called lapping. Nelson concocted a plan made possible only by an internal control deficiency at the company big enough to drive a truck through. Unrestricted access to live data, read customer accounts. Even as the bank's chief programmer, Nelson never should have had access to such data, but he did. That could have been because he was the principal architect of the entire computer system. Okay, so we already know, what are we looking at here? What's the problem? Hmm? Poor segregation of duties. This guy designed it, and he's the only one who runs it. That's no good. Okay, we could identify that already. That's a problem waiting to happen. Okay, so what did this guy do? Nelson set about reprogramming the bank's computers to accommodate a highly complex and seemingly foolproof lapping scheme. How does that work? The bank's computers were programmed to print account statements throughout the month. For example, customer A's statement was mailed on the first day of the month, customer B's on the second, and the last one on the 30th. That being the case, Nelson figured he would have use of the funds for 29 days, no more. So he programmed the computer to simply roll the $15,000 through the ending balance field on other checking accounts according to a predetermined schedule. Nelson's plan, in effect, was to let the money bounce through the computer system until he could legitimately repay his loan. So what he would do, they would send out the customer account receivable statements different days. So the first day of the month, customer A would pay their $15,000 in receivables. He would pocket that money. The next day, customer B would pay. He would take that 15,000 and use it to pay customer one's account. Third customer would pay, would use that money to pay customer two's account. And he would keep going throughout the month. As long as he put that money back by the end of the month, everything was fine. And he got an interest-free loan of $15,000 every month. Yeah. I'm sorry, I can't. Yeah, I don't know every little detail of this, but that's basically what he did. And that's called lapping. That's the point of it. Nelson's plan was probably doomed from the outset. Once the first attempt is successful, lapping tends to increase at exponential rates. Now the fraudster has to steal from other customers. Then there are many accounts to keep track of. Okay, so that's another fraud technique called lapping. So going back to this, we've done these four methods of improper revenue recognition. We already know about cutoff, bill and hold, channel stuffing, and lapping. Okay. What are the other big inherent risks that we're always worried about when we're doing revenue? Returns and allowances. Are they properly recording all the sales returns that happen? And the collectability of receivables. Okay, are they putting receivables as collectible when in fact they should be written off as bad debts? Or is their allowance for doubtful accounts properly valued? Okay, key control procedures. Okay, again, what the textbook is doing here, we take all the basic principles of internal controls and apply them to the revenue account. So you can see here, they've got in all caps all the basic principles of internal control that we know: segregation of duties, authorization of transactions, access to assets, adequate documents and records, and independent checks on performance. And then they just detail exactly what does that mean for the revenue and collection cycle. So segregation of duties, separate functions for recording, authorization, and custody. So somebody is the bookkeeper, does the journal entry, somebody authorizes this sale can take place, and somebody else has custody of the inventory and of the cash. Okay. Authorization of transactions, write-offs. Okay, you guys remember this. Um, with a particular, even though you estimate accounts receivable bad debts, if you find a particular account, you decide the customer isn't going to pay you, you write off that account receivable. So there should be one person in charge who can authorize, yes, you can write off this account receivable. So is there proper authorization of transactions? There's a person in charge who can say, okay, write off this account receivable. Electronic transactions, credit checks prior to approval of sale. Okay, we already saw that in our flow chart. Before you sell to a customer on credit, somebody approves, yes, you can sell to these people on credit. And pricing. Okay, there should be a price list. If you're the person on the phone taking customer orders, you should have a price list in front of you. This is what we sell at. You can't deviate from that without a supervisor's approval. There can be a supervisor who says, okay, we can give these guys a volume discount, but the person taking the sales order doesn't have the authority to do that. They use the price list that was given to them. Okay, access to assets. There's a shipping department, okay, with security guards and everything, and lockbox accounts. So all the cash and checks are kept under lock and key until they're deposited, which should be every day. Adequate documentation and records, pre-numbered sales orders. We talked about that. All documents should be pre-numbered. Shipping documents or bills of lading. That's a term that comes up. If you ever see bills of lading, it's really just a shipping document. You can think of it as the same thing. Okay, sales invoices and remittance advice. And then finally, independent checks on performance. So somebody like an internal auditor checking the AR ledger to the general ledger. Do the two match up? And monthly statements are sent out to all the accounts receivable customers is another way to reconcile. So again, taking all the principles of internal control we know and applying them to the revenue accounts. Okay, we're going to see a slide like this from the textbook in the next several chapters. Audit evidence and management reports and data files. Um, right. So every client, every company should have these basic files that you can just ask for. Good record keeping, they would have all of these files. So you can just say, I'm going to be on site next week. Please have all of these files available for me, and they can pull all of them, no problem. Okay, what should be there? A pending order master file. What's that? A pending order master file. Right, the ones that aren't completed yet. Yeah, that's right. So the ones that are in process, there should be a file of those. And one thing, they shouldn't be sitting around too long. When you get an order, you should be finishing it up quickly. Credit checks and approvals. So you can see that they are running credit checks on everybody before they sell to them on credit. A price list, we already talked about, you should have. A sales journal with all the journal entries for every sale. Sales analysis, an accounts receivable aged trial balance. Okay, you guys have seen that, right? What's an aged trial balance for accounts receivable? Yeah, right. You have like a spreadsheet with columns, right? Not due yet, due now, 30 days overdue, 60 days, 90 days overdue. You guys have all seen that? Okay, so what you would do as an auditor, you want to make sure that allowance for doubtful accounts is properly valued. So if they're saying the ones that are 90 days overdue and they say they're going to collect 95% of those, you might say, are you sure you're going to collect 95% of these and it's been 3 months and they haven't paid you? Maybe you want to think about increasing the doubtful accounts on that one. Okay? That's actually something you're going to do in your case. You're going to look at their aged accounts receivable and see if they're properly valuing it. Okay, cash receipts and customer statements. So these are all standard files that the client should have. You just ask for them and they can give them to you, no problem. Okay, so this is just copied out of the textbook. You can look at it on your own. They're giving you examples. What's the assertion you're testing? What are the controls that should be in place? And how exactly you're going to test those controls. So, for example, occurrence. Sales and related events have been recorded that have been recorded have occurred. So the sales really exist or they occurred. What are the controls that should be in place to make sure that happens? Invoices supported by customer purchase orders, bills of lading, or other shipping documents exist for all invoices. Okay, and how would you test these controls? Check agreements of sales and sales details filed to invoices supporting shipping documents and customer purchase orders. So just like we said, you want to make sure the sale occurred, you go to the shipping documents to check for evidence that they occurred. That's what they're saying here. And they got examples of all these things that you can read through, help you get it. Okay. Um, so one of the major things you'll do when you're auditing the revenue cycle is to audit the accounts receivable account. Okay, you're going to test the accounts receivable age schedule like we just talked about. Are they properly valuing the bad debts? Are they properly estimating bad debts, I should say? Okay, and we just mentioned a really important thing is confirming accounts receivable balances. As we said, you are going to actually write letters to a sample of the accounts receivable customers and say, according to the client's records, you have an outstanding account receivable of $2,000. Is this correct? You send it out to the client and not the client, the customer. The customer writes back, yes, this is correct. Okay. No, we can talk about why that happens. You guys heard of the McKesson and Robbins audit scandal? Yeah. Okay. Before Enron, McKesson and Robbins was the biggest audit scandal in American accounting history. So in 1939, they found out that this company, McKesson and Robbins, had been inventing accounts receivable, all these customers that didn't exist, and they had been inventing inventory. On their balance sheet, they had listed all this inventory at these warehouses in Canada that didn't exist. But their auditor, Price Waterhouse, wasn't checking any of this. They did not confirm accounts receivable with the actual customers, and they didn't go to these warehouses in Canada to confirm that they existed. This had been going on for 14 years. Price Waterhouse had been giving them clean opinions for 14 years. All 14 years, those warehouses didn't exist. Those receivables were made up. So because of that scandal, they put in that standard audit procedures are you confirm accounts receivable and you physically inspect inventory. Now you do that in all audits, and we learn it in classes like this. That's because of the McKesson and Robbins scandal of 1939. There are a few things you could do. First of all, you still want to think about if it's material. If it's a tiny warehouse that doesn't have much stuff, maybe it's not worth it. Or you could hire another auditor in another state or in Canada or something and say, please just do this simple thing for us. Go and check the inventory. These days, somebody suggested this once. These days, you could probably use Google Maps to confirm that the warehouse is there. That's true. It wouldn't do that. You're right. So we'd need a drone or something to look in the window. Mhm. Okay, so we're going to talk all about that, confirming accounts receivable balances. You're going to do analytical procedures, like we've already learned. That's looking for consistency year to year in allowance for doubtful accounts. And you're going to test sales cutoff, which we've been learning. Okay, so accounts receivable confirmations. Like we said, this is a standard procedure that you'll do in pretty much every audit. It is to test the existence of accounts receivable. Factors affecting likely to affect the reliability of confirmations. Your previous audit experience, the percentage of confirmations completed and returned in the past. So as we said, what you'll do, you, the auditor, send out a form letter. According to the client's records, you have an outstanding receivable of $2,000, yes or no. Now, from the customer's perspective, when they get this letter, they really couldn't care less about the audit of the company that they buy stuff from. So a lot of times they'll just throw it in the trash. So even though this is a required audit step, a lot of times you're not going to get the evidence because the customers don't bother to write back to you. So previous audit experience will tell you, even though you're always supposed to do this step, if nobody ever writes back to you, you're not collecting any actual evidence and it's not effective. Okay, who are you going to send it to? The intended recipients. You can look at the size and reliability of the customer. So you usually won't send it out to all of the customers. You'll do a sample. So you can do, for example, the biggest ones, the most material ones, send it to them. Okay, the type of information being confirmed, that is a negative or positive confirmation. We're going to look at that in just a second. And the auditor may confirm entire balances or individual transactions. So you can write to a particular customer, this is your total balance. Can you confirm? Or you can just look at a particular transaction. You have this account receivable for September 9th. Is that true? Okay. That's up to the auditor, which one you want to do. Okay, so types of confirmations. There are three different basic types: negative confirmations, positive confirmations, and blank confirmations. In a negative confirmation, the customer will only respond if the balance is incorrect. Okay, so you write the letter saying, according to the client's records, you have an outstanding receivable of $2,000. If this is correct, you don't need to respond. If this is incorrect, please write back to us. And then the textbook says here, when will you do this? When the combined assessed level of inherent and control risk is low. So they're going back to our audit risk model. Okay, and they're saying the combined level of inherent risk and control risk is low. They're saying that's when you would do a negative confirmation as opposed to one of the other ones. What does that mean? Well, what are they talking about? We know this. When control risk is low, what does that mean? Detection risk is high, which means less work for the auditor. Okay. So you do this test, negative confirmation, when you think their control risk is low, meaning they have good controls. So you don't think there are going to be any problems. So you are going to do the least quality work, the least amount of work. Negative confirmations are not great evidence because, as we mentioned, if they don't write back to you, is it because everything is okay or is it because they threw it in the trash? You don't know. So it's not great evidence. You would only do that when you already have confidence in their internal controls and you're not expecting a problem. Okay, so detection risk is the amount of work you would do. It can also be the quality of work. You're doing the low quality confirmation, the one that takes the least amount of work and gives you the least quality evidence because you don't expect a lot of problems in accounts receivable. They have good controls over accounts receivable. Okay, the other two types of confirmations are better quality audit evidence when the controls are not so good. A positive confirmation means all customers are asked to respond. You write in the letter, please respond yes or no, whether it's correct or not. And then finally, you do this when there are a small number of accounts, so none of them by themselves are really material, or when a large number of errors are anticipated. That is, inherent risk and control risk are higher. You're expecting a lot of problems. Then finally, the best quality evidence is blank confirmations, where the customer has to write in the amount. So you write a letter, please tell us what the outstanding account receivable amount is. So then the customer has to actually go to their files and look up the number. Okay, so what they could do with a positive confirmation, it says $2,000. They could say, yeah, that sounds right, and just check off that's okay. With a blank confirmation, they are forced to actually go to their records and look up how much they owe. Now, again, that's more work for the customer. It's less likely they're going to go to that trouble for you since none of this matters to them. But if you can get them to do it, that's the best quality evidence. You do that when controls are poor, detection risk is low, and you need to get good evidence on accounts receivable. Okay, does that make sense? Negative confirmation is the least quality evidence. Positive is better, and blank is the best kind of evidence. So when controls are good, you use negative. When controls are bad, you use positive or blank. Everybody can follow that? Okay. All right, let's take a break now. 8:17, we'll be back.
This lecture off election.
Yeah.
Okay, back in business. So we finished this one. Any questions on this slide? All right. So when they're going here a little more detail, what are some things you want to think about with these confirmations? Some things you want to have in mind. All confirmations returned by the post office as non-deliverable must be investigated. Okay, so if you sent the letter out and then it came back and said no such address, now you're suspicious. That's a red flag. So you have to follow up on that. Responses to positive and blank confirmations provide more reliable evidence than negative non-responses. We already know that negative confirmation is not great evidence. Positive and blank are much better evidence. The recipients of accounts receivable confirmations might not report understatements. Okay, so what they mean is, if you say, is it correct that you owe $2,000 and it's actually 2,500? The customer might think they can get away with something if they confirm the 2,000. So you want to be aware they might underreport, or they might not let you know that it's been underreported. Auditors must have heightened professional skepticism for electronic responses sent by fax or email. You guys know emails can be easily copied and faked, so verify that the response came from an appropriate person at the employer. Okay, what happens if you get a non-response to a positive or blank confirmation? Remember, with the positive or blank, you're asking everybody to write back, whether it was correct or not. So what if somebody doesn't write back to you? Follow up with a second or even third request. A lower than expected response rate could be indicative of fictitious customer accounts. Right. So if you're expecting everybody to write back and then some of them don't write back to you, we already know some of them won't write back to you because they won't bother. But if there's a lot of them not writing back to you, there's also a possibility that these customers don't exist. That's less likely, but it is a possibility you want to follow up on. So when you get there positive and blanks that aren't being returned to you, you do want to keep following up, try to confirm whether these people actually exist or not, or whether these customers are fictitious. Okay, this is something we're going to be talking about a lot in the next few chapters, alternative procedures. Okay, so in general, what that means, there's an audit test you want to do, but for whatever reason, you're not able to do it. You still need to collect the evidence. So you need to find some other way to collect evidence about this account. That's an alternative procedure. So, for example, with accounts receivable, we already mentioned the customer has no particular responsibility to get back to you. They might not bother. So, what if you're sending out these letters and the customers don't write back to you? Now you're not getting the evidence you need. So even though you're supposed to do this confirming account receivable, it's not getting you any good evidence. So, you still have to check account receivable. So, what are you going to do? You have to find an alternative procedure. One common alternative procedure for accounts receivable is called subsequent cash collections. Okay? Subsequent cash collections. So what you'll do as of December 31st, there's something on the balance sheet, a particular balance for accounts receivable. So the fiscal year ended December 31st. You're doing your audit in January, February, and maybe early March is when the report goes out. So by late February, that's 2 months after these accounts receivable were recorded. So by then, most of them should have been collected. So you can check the December 31st accounts receivable, you can check in the end of February. Have most of them been collected? If they have, that's evidence that these accounts receivable are real because people are paying them. So that's an alternative procedure. You weren't able to do the confirmation of accounts receivable, so you do something else by looking at the December 31st receivables at the end of February and seeing if they've been collected. And as I said, we'll keep coming back to that. When you want to do some audit procedure, you're not able to, so you have to find something else that's called an alternative procedure. A non-response to a negative confirmation request. It is only limited evidence concerning financial statement assertions. So, like we said, when you send out the negative one, you say only respond if there's a problem. So, if they don't write back, you don't know if it's because it's correct or because they didn't bother to write back. Alternative procedures are not necessary for unreturned negative confirmation requests. They said when positive or blank are not returned, you want to follow up. With negative, it's not necessary. Okay, and then they say follow up on all exceptions. So whenever a customer writes back to you, that's incorrect. The balance is actually 1,000, not 2,000. Whenever you get one of those back, obviously you need to follow up on that and correct the discrepancy. Okay, so they give some examples here of what might happen. The customer writes back to you, this amount was paid on December 28th. This account is probably valid as the check was probably received after year end. So what happened on the December 31st balance sheet, it said that the receivable was outstanding. So you send them a confirmation and they write back to you, no, we mailed out the check on December 28th. Probably that's just fine. You just want to check the subsequent receipts that they did get it maybe early January sometime. Okay, so this is a common response. You can easily find out, did they in fact send out the check or not? However, it should be treated as an exception and the date of the as an exception, and the date of the receipt should be verified. Okay, another type of response you might get. We are unable to confirm this amount. This is treated the same as a non-response, and alternative procedures should be performed. So you ask them, is it correct that you have an outstanding balance of $2,000? They say, we can't tell you that, we don't know, or no, that's not right. That's a problem. Okay, we return these items. This is an exception that should be discussed with the client. The auditor should verify that there are no other returns included in receivables. Okay, so what are they saying happened here? The customer will wrote back to you, we return these items. What does that mean? What happened? Yeah,
Something.
right. So they sent a return, they returned the merchandise, but for some reason the client didn't do the journal entry to take off the account receivable and record a sales return. So now you found a problem. Okay, the client doesn't have good sales returns controls in place, that when the customer sends back a product, they need to be doing the journal entries. This is no longer an account receivable because they returned it. They're not doing that. You found a problem with the client's controls. Okay. We received these goods on January 3rd. This is also probably valid as the shipment was probably made in late December. However, this should also be treated as an exception and the shipment should be verified. The auditor should also make sure the goods were removed from the year-end inventory. Okay, so again, according to December 31st, it was outstanding, but the customer is saying we didn't get it until January 3rd. So obviously it wasn't a receivable on December 31st. Probably they're right. It's just a timing thing, but you want to follow it. Okay, alternative procedures. We just talked about that. Well, yeah, and we use this example, vouch subsequent cash collections. That is usually sufficient evidence of existence and valuation. So you look at the receivable still outstanding on December 31st and check if 2 months later, late February, when you're still doing your audit, have most of those been collected. You can examine shipping documents like bills of lading or other third-party evidence. So you can't confirm whether it's an outstanding receivable. At least you can confirm that it was sent out, so it was a real sale. That's part not fictitious. Examine client-generated supporting documentation such as invoices and inspect correspondence files, which is maybe the customer has been writing to you, why do you keep sending me these bills for this account receivable? We paid this a long time ago and we don't owe you anymore. If you're getting a lot of letters like that, that might suggest that the client isn't keeping good track of their receivables. Okay, uncollectible accounts. We talked about that. They have to estimate allowance for doubtful accounts, inspect customer files for collectability, recalculate their allowance and their bad debt expense, verify the reasonableness of allowance and bad debt expense. Okay, so if they're claiming right this year that their bad allowance for doubtful accounts is 1%, they're going to collect 99% of their receivables. And you look in previous years, they only collect 95% of their receivables, then maybe 9%, 99% is not realistic. They need to increase their allowance for doubtful accounts. Inspect documentation for appropriateness of accounts written off. Inspect documents for additional collection procedures and inspect documentation for appropriate authorization. So we mentioned this before. If you actually write off an account receivable, like we've determined this particular customer went bankrupt, they're not going to pay us, so we're writing it off. That should have been properly authorized. Not anybody, not just the bookkeeper can go ahead and do that. Someone is in charge with the responsibility to write that off. So check that all of the accounts receivable written off were done through proper procedures and properly authorized. Okay, analytical procedure. One of the fundamental audit techniques we've been talking about. You can do that for sales revenue, compare it with previous periods, and compare it with the industry. You can do that with allowance for doubtful accounts and bad debt expense. And you can do it for accounts receivable with some basic ratios like day sales and inventory and accounts receivable turnover. So again, using basic financial statement ratios and comparing for previous years, what are you looking for basically when you're comparing with previous years? Consistency. Okay, that's the first thing you should be seeing. If they're in the same business, selling the same products to the same customers, all these numbers, all these ratios should be about the same year to year. When you see something that is not consistent, a major increase, a major decrease, that's when you've identified a red flag that you need to follow up on. So these analytical procedures, primarily, they're showing you consistency. That's what you're looking for. Oh, okay, finally. So sales cutoff, we already know this, but we can just review it. It is used to verify whether the sales and revenues have been recorded in the correct accounting period. How you do that, you examine sales invoices and shipping documents shortly prior to and after year end, and also examine all the returns that happen after year end. So, an example, you shipped out to the customer on December 29th, FOB shipping, and they received it January 2nd. Is that a sale this year or next year? Hmm? This year, right. How do you know that? When did it become a sale? It was FOB shipping, so the date we shipped it, December 29th, it belongs to the customer. So this is a sale on December 29th. Okay. What if, on the other hand, FOB sent out December 29th, FOB destination, and they received it on January 2nd? That's next year's sale. It should not be included as a sale this year. Okay, everybody understands that, right? Knows what I'm talking about. Uh, Couple more handouts. Oh, here's an interesting one. SEC finds Newell Brands. SEC finds Newell Brands 12.5 million for misleading investors. Newell veiled subpar sales using various accounting changes and disregarding warnings from its audit committee and auditor. This is about 2 years ago. The Securities and Exchange Commission fined Newell Brands 12.5 million and its former CEO 110,000 for misleading investors about sales growth in 2016 and 2017. As sales lagged company goals, Newell and former CEO Michael Polk pulled future sales into earlier quarters without adequate disclosure, overriding internal accounting controls and disregarding generally accepted accounting principles. The company then misled investors by saying their results were strong or solid. Newell's former CEO issued an instruction to scrub the company's accruals after he learned that the company was projecting a massive and disappointing miss for the quarter. Senior executives risk abusing the duties attendant to their offices when they reach into a company's accounting control processes as a way of making up for performance shortfall. What do we call this when management reaches into the accounting control processes? We had a term for that. Management is, yeah, earnings management, specifically, what is management doing with the controls? Overriding controls. This is management override of controls when they ignore the controls. More, yeah, they give a little more detail here. During the last month of each quarter, after employees determined that sales would undershoot internal targets, investor guidance, or analyst estimates, Newell identified orders scheduled for delivery early in the next quarter and obtained customer permission to deliver the orders in the current quarter. Newell also used pick and holds tactic, in which employees shipped goods early to customers without their approval, arranging for third parties to store the goods for days or weeks until delivery on dates during the next quarter requested by the customers. In quarter two 2017, a member of Newell's audit committee and the company's auditor expressed concern to company management about various reclassifications. Newell disregarded the warnings. Okay. So there's one potential problem. The auditor knew about this and warned them about it, but apparently didn't force them to make the changes, which is what they're supposed to do. Okay, so these guys were recognizing revenue a little early to make their quarter numbers work. Yeah, that's okay. All right. Chapter 7 problems. Hmm. Yeah, okay. Right. Yeah, okay, we'll do this one. 7.68, audit objectives and procedures for accounts receivable. In the audit of accounts receivable, auditors develop specific audit assertions related to the receivables. They then design specific substantive procedures to obtain evidence about each of these assertions. Okay, this is 7.68 on page 308. This one, you really need to have it in front of you in order for us to do it. How many of you actually have this problem in front of you? Okay, please pull it out if you have it. In the For each of the following assertions, select the following audit procedure numbered 1 through 7 that is best suited for the audit plan. Select only one procedure for each audit objective. A procedure may be selected once, not at all, or more than once. Okay. So they give you four assertions, and then they ask you to choose among these different audit tests which one would best test this assertion. So the first one, accounts receivable represent all amounts owed to the client company at the balance sheet date. Okay, so what assertion is that? Accounts receivable represent all amounts. What assertion is that? That's completeness, right? All amounts means completeness. All accounts receivable were included. And then how would you do that? Which one of these 7 tests is the best choice to test completeness on accounts receivable? Go ahead, you guys. Yeah, I like number 2 on that one. Perform sales cutoff tests to obtain assurance that sales transactions and corresponding entries for inventories and cost of goods sold are recorded in the same and proper period. Okay, so we already talked about this. To test completeness, cutoff testing is the way to go. Okay, B, the client company has a legal right to all accounts receivables at the balance sheet date. Okay, what assertion is that? They have the legal right to all accounts receivables, which is assertion. Rights and obligations, of course. And which one of these tests would do that? Five. Five is review loan agreements for indications of whether accounts receivable have been factored or pledged. Okay, so do they have the right to these receivables? If they've been factored, then they sold them, they don't own them anymore, so they don't have the right to collect them anymore. Okay, so testing that will tell you whether they have the right. So looking at the loan agreements for whether any of them have been factored. Okay, C, accounts receivable are stated at net realizable value. What assertion is that? Stated at net realizable value. That's valuation. And how would you test that? Number 3, review the age trial balance for significant past due accounts. Okay, we already talked about that. If they have a lot that are 90 days overdue, Probably most of those aren't going to be aren't going to be collected. So that's a good way to estimate the proper allowance for doubtful accounts. Okay, and D, accounts receivable are properly described and presented in the financial statements. Okay, which assertion is that? Properly described and presented. That's presentation and disclosure. And how would you go about test? Which is the best way to test that one? This one's a little harder. There might be more than one answer on this one.
Is it one?
No, I like number 4 on that one. Obtain an understanding of the business purpose of transaction. So you're testing whether accounts receivable are properly described and presented. So you find out what was the business purpose of this transaction. If it's not a sale on credit, then it shouldn't be an account receivable. It should be something else. Maybe it's a note receivable, or maybe it wasn't a sale to a customer at all. But checking the business purpose would tell you whether it's properly presented in the accounts receivable account. That one's a little harder. Okay. Everybody feel good? Yeah, yeah.
A, five, two, three.
That's right. That's right. Okay. Everybody feel good about chapter 7? All right. We can at least get started on chapter 8. Okay. I posted chapter 8 slides, right? Yeah. Okay, good. Okay. So this is the second of our 4 account cycle chapters. This is the acquisition and expenditure cycle. So when the company buys stuff. Okay. As always, we're going to identify the big risks we're dealing with here. There are several different accounts involved. You're worried about unrecorded liabilities. That is, they have a liability, but they didn't record it. What's that about? What assertion are you testing there? An unrecorded liability would be an issue of completeness, non-cancelable purchase agreements. Do you guys remember purchase agreements? What's a purchase agreement? Yeah, right. You agree to buy something before you actually buy it. You have an agreement to buy it later on. So you'd be worried they haven't recorded this purchase agreement, but they have made a contract. So they should have recorded it, but they didn't. Again, underreporting their liabilities. Capitalizing expenses. So should it be capitalized or expensed right away? And you're worried about the purchasing department. That's a good area for fraud and manipulation by the employees. So what'll happen? There's in a big company, there's a separate department. Their whole job is just buying stuff, the purchasing department. What they could do, the way a fraud can happen, they will make a side deal with the vendor. Like, I'll send all the business your way. In return, you give me some cut of the sales that you get. Okay, so these are again all the big risks. So since we're talking about acquisitions and expenditures, these are liabilities and expenses. And we said, what are the worries? What is the main worry with a liability and an expense? Under Underreporting them. Assets and revenues, we're worried about overstating them. Liabilities and expenses, like these accounts, we're worried about understating them. So we want to test if you're worried about understating an account, do you want to test which assertion? Completeness, all the liabilities and all the expenses got recorded, and we test completeness with tracing. Okay, so again, I put together a simple flow chart. So this goes back to the one where the department wanted to buy a copy machine. So they want a copy machine. First, they fill out a purchase requisition. That's the first form in the voucher packet and the audit trail. Then the purchase is authorized, and they fill out a purchase order, which is sent to the vendor. Then you will receive the goods, and you'll get a receiving report attached to that. Now that it's been received, you can record the liability accounts payable, and you will also receive the vendor's invoice in the mail evidencing the payable. Finally, you can pay the vendor, and you should have a completed voucher package that the treasurer looks at, that all these documents along the way were properly filled out before they write a check to pay off the account payable. Okay, and what are you doing here when you create a flow chart like this? You are documenting the internal control, documenting your understanding of the internal controls over the purchase and acquisition cycle. Yeah, yeah. Well, they would happen at the same time. You've received the good, so now you can record a liability. Until you've received it, it's not a liability, right? Well, when you order, you haven't received it yet. I don't think you should be recording a liability just because you ordered it. It hasn't become an expense yet. When they've shipped it to you, whether it's FOB shipping or destination, when it actually becomes yours, they record a sale and you record a liability. But it should be, for example, when you have physically received the goods. Okay, what are the typical activities that go on? Oh, this is a good example. This is just the flow chart put into a narrative or memo form. They're documenting how do the controls work, and they're putting it in a narrative form. So what happens? You purchase goods. You do that by the department requesting a purchase, preparing a purchase requisition. Then the purchase is approved by preparation of a purchase order. This could be done electronically. Then you will receive the goods. After the vendor approval, the goods are received by the company, evidenced by preparing a receiving report. You record the asset or expense and related liability, and you have evidence for this with the vendor's invoice. And finally, you pay it through the cash disbursement process after reviewing the voucher packet of all the completed forms. So this is just a different way to document the internal controls. This would be an example of a narrative form. Okay, audit evidence and management reports and data files. So we did this in chapter 7. These are the standard files that any client should have. You can just ask them, I need to see these, and they can give them to you no problem because they keep these records. Open purchase orders. Okay, what's an open purchase order? Right, we ordered it, we haven't received it yet. They should have a file of those, all the ones in process. Okay, these are important ones. Unmatched receiving reports and unmatched vendor invoices. What do you think that is? Unmatched. I'm sorry, I can't hear. Actually, that's a good guess, but actually, no, that's not. What this means is you have a lone piece of paper sitting there that's not matched up with anything. So, like an unmatched receiving report. So, you, the auditor, go through and you find there's this receiving report, but there's no purchase order, no purchase requisition, and no vendor invoice to make a completed voucher package. So now you're worried. Where did this receiving report come from? Okay, there could be two potential explanations. Maybe they received something they never ordered, which is a problem, or maybe everything was fine and nobody matched up this piece of paper to the rest of the voucher package, just a paperwork mistake. But either way, there's some kind of control problem going on. You should not have unmatched documents. Everything should be part of a completed voucher package. There should be all the different pieces. Then there's a problem. Oh, and another thing I want to emphasize, open purchase orders means they're in process. One thing you should be looking at, they shouldn't be in process for too long. So if you, the auditor, are looking through the open purchase order, if there's something that's been an open purchase order for a month or 2 months, you maybe want to follow up. What happened to this? Why hasn't it been followed up on? I'm sorry, why hasn't it been completed? It could be, for example, they did receive the goods and nobody again matched up the voucher package, the purchase order with the receiving report and the vendor invoice. Okay, a trial balance for accounts payable they should have, a purchases journal, and a fixed asset report. Again, all standard files that they should be able to give you, no problem. Okay, again, back to vouching and tracing. Okay, so you can do vouching, which is you start with the purchases journal, okay, the accounting record, and go back to the vendor invoice and go back even more to the receiving report. So all these are recorded in the journal as purchases. Were they real purchases? The vendor invoice is evidence of a real purchase, and the receiving report is evidence of a real purchase. Is that their priority, though, when you're dealing with a purchase? Are you worried that they would record a purchase that never happened? Okay, that's less likely. What's more likely? But they won't record it. So you would find receiving reports, and then they were never recorded in the journal with a journal entry. And that is testing, not vouching, but tracing, testing the completeness. Everything that was received on their loading dock ended up being recorded as a purchase in the accounting records. And every invoice that they got in the mail was recorded, or it was sent back saying, we never bought this stuff. Okay, can everybody follow that? We're back to our old vouching and tracing. And in this case, we're talking about liabilities, purchases, stuff we bought. So we're most worried about completeness, which is tracing, and not existence, which is vouching. So again, in this account cycle, we're emphasizing the completeness assertion. For revenues, it was the existence assertion. Here it's completeness. So you need to search for unrecorded liabilities. That is, they have a liability, but they didn't record it in the accounting records. How do you search for that? Inquire of the client about their procedures. So if they have good internal controls, hopefully all the liabilities and expenses will be properly recorded. Scan the open purchase order file and examine unmatched vendor statements and unmatched receiving reports. Again, if there's some lone piece of paper out there, it could be just poor paperwork. This transaction did happen, but it wasn't recorded properly. All the paperwork wasn't done. Trace unpaid vouchers and accounts payable. Confirm accounts payable with suppliers. Okay, so as we said, it's a standard procedure to confirm accounts receivable. It's not as standard to confirm accounts payable, but if you think it's important, you can go ahead and do that. Take a sample of the outstanding accounts payable and write to the vendors, according to this, our client owes you $2,000 for the purchase of a copier, yes or no? And they can write back, yes, that's right. Review cash disbursements occurring after year end. So you can look at credits to cash, and if they don't match up with anything, you can say, what were these credits? Maybe they bought something and didn't record it as a liability like they were supposed to. Okay, back to cutoffs. Okay, we already know this, but we can always review it. Verify cutoffs for purchases. Examine receiving reports and vendor sales occurring around year end to ensure that inventory is included in the appropriate period. So, for example, we bought goods on December 28th, FOB shipping, and we received them January 2nd. Is that our inventory this year or next year? This year. FOB shipping means it became ours, the customer, on December 28th. What about we bought goods FO 1228 FOB destination, received them January 2nd? That does not belong on this year's inventory. That became our inventory on January 2nd. Okay, here's an example of what you could have some working paper. So the client has this account, prepaid expenses. Here it says prepared by client. Here are all their prepaid expenses, prepaid insurance, prepaid rent, and office supplies. And now you're auditing it. So here, let's next to last year's ending balance, you wrote PY. So what is that? Prior year. And what did you do? What do you think that tick mark? What does that represent? What did you do? I'm sorry. I'm sorry, I can't hear you. What did you do? You wrote PY prior year next to last year's balance. What do you think you actually did? That's right. You went to last year's work papers and confirmed that's right. That was the ending balance, December 31st, 2007. You did that for all three of these additions. So that means they bought more insurance. You put a little tick mark there. You saw an invoice or something that, yes, they purchased more insurance. Amortization and disposal. Okay, a C could mean what? Calculated? Well, I'm thinking it means calculated. So this is their amortization of their insurance policy. Did they do that properly? You recalculated it, like, I don't know, half of it was used up this year. It's a 2-year policy, something like that. But you checked their insurance expense calculation and made sure it was done properly. Okay, and then they write X dash 10. What do you think that's referring to? I think it's probably another work paper, right? Cross-referencing. If you want to see the details of this amortization calculation, go to work paper X10. That's where we redid the calculations for prepaid insurance expense. Okay. And then here at the bottom, they wrote F's. What's that? Footed. They added up these totals. And here they wrote CF. What do you think that might mean? Cross-footed. That means they did it horizontally. Okay, so they added up all these numbers to get this total. Yeah. I'm sorry. I think that's this one, the additions, just means you checked or you vouched that they did, like you saw an invoice, they bought another year's insurance or something like that, and the V is the tick mark they're using. Some of these aren't universal. It might be this particular auditor uses V to say I saw an invoice, something like that. Oh, and finally, they wrote here at the bottom TB. What trial balance? That's a cross reference. You can find this total in the trial balance.
How big is the other?
I'm sorry? Sorry, where is that? Oh, this. Right. Oh yeah, I see. So that's the balance in the client's records before the audit was done. And now we're doing the audit and confirming it. But the client did it. They don't do the audit. So this is their balance before an audit checked it.
If they, sorry, if they had additional prepaid expenses and then they had amortization, it doesn't mean that it had to match with the balance.
It doesn't match. I would hope it matches. That's something you would probably do is calculate it. Like the V here, you checked it. Here was the beginning balance in office supplies, additions, subtractions, leading to the ending balance of 7,406. Hopefully that balances. That's something you would probably want to check. Okay, that's a good place to stop, actually. The next is another topic. Okay, so we're on target. Everybody, you can start working on the case, at least take a look at it, make sure you know what's going on. And next week we'll finish chapter 8 and get to work on chapter 9. Okay? All right, thank you, everybody.